Well, welcome back to the video on the cost of production. We're going to start off with the short run total cost curves. You'll have to recall that the short run is the company has at least one, but not all factors of production are constant. At least one factor of production is constant. That's one of the important things to realize when we're dealing with the short run. So the total cost curves, the short run total cost curves, they show the minimum cost of producing various levels of output. You'll have to recall that in the section on the theory of production, we said we are using the best production techniques available. So they'll come in at the lowest cost, the minimum costs. We're going to be interested in both the explicit and the implicit costs. So the explicit costs refer to the actual expenditures of the firm to purchase or hire the inputs it uses. These are the costs that you're familiar with from your accounting courses, the ones that the accountants actually record in their ledgers. Implicit costs refers to the value of the inputs owned by the firm and used by the firm in its own production processes. So the value of these owned inputs should be imputed. In other words, they have to be estimated from what they could earn in their best alternative use. What we're referring to here is their opportunity cost. And once again, please highlight bullet point number 2. In the short run, one or more, but not all factors of production are fixed in quantity. That is the key to the short run. The first cost that we're interested in is our total fixed cost, and it refers to the total obligations incurred by the firm per unit of time for all fixed inputs. Some examples could be your insurance cost, interest payments on borrowed money, certain taxes. In your accounting courses, it was referred to as overhead. Your total variable costs are the total obligations incurred by the firm per unit of time for all the variable factors it uses. Payment for raw material every time period, be it on a daily basis, weekly basis, monthly, or yearly. The use of raw materials can change and will change, so that makes it a variable cost. Your labor costs are variable. So if a company hires somebody for the first week and they work 10 hours at $20 an hour, they earn $200. The second week, the person is working 20 hours at $20 an hour, they're earning $400 that week. It's a variable cost. Fuel, the amount of energy that you consume, is another example of a variable cost. And depreciation associated with production is another example. So your total costs are going to be the addition of your total fixed costs plus your total variable costs. That's the first equation that we will be working with. So as an example, the table that I'm about to show you has your total fixed cost plus, and it shows total variable costs. You add those two together and you will get your total costs. So here is that table. Your total fixed cost plus your total variable cost equals your total costs. So 60 plus 0 is equal to 60. 60 plus 45 is 105. 60 plus your variable costs of 20 is 180. We're going to graph this data now. Your total fixed cost, total variable cost, and your total costs. And your graphs are going to look like this. Your total fixed cost curve is a parallel line to the x-axis at $60 above the x-axis or the quantity axis. Here is your total variable costs. It is a stylized S. This T double prime means that to the left of it, the law of diminishing returns has not set in. Then at T double prime, which is about 2.5 here, the law of diminishing return sets in and the total variable costs start to skyrocket. Your total cost is nothing but the addition of your total fixed cost plus your total variable costs. It takes on the total cost curve takes on the exact same shape of your total variable cost, but 60 units above it. So you're going to add your total fixed cost plus your total variable costs, and you're going to get your total cost. So what can we say? We're going to go into a little more detail here. So from the table and the graph, we see that your total fixed costs are $60 regardless of the level of output. If you produce 0 units of output, your total fixed costs are still $60. If you produce 100 units, your total fixed costs are still $60. This is reflected in your total fixed cost curve, which is parallel to the quantity axis or the x-axis, $60 above it. Your total variable costs are 0 when the output is 0 and rises as your output increases. So you're buying more raw material, so your total costs will go up. The particular shape of your total variable cost curve follows directly from the law of diminishing returns. Please, in your notes, if you've printed them, please highlight bullet point number 2. Up to T prime, that is in mathematics called the point of inflection. The slope changes. The firm is using so few of the variable inputs together with its fixed inputs that the law of diminishing returns is not yet operating. So the points to the left of T double prime indicate that the law of diminishing returns has not started to operate. The total variable cost curve is concave downwards up to that point in time. And the total variable cost curve increases at a decreasing rate. So you see it's flattening out. At T double prime, the law of diminishing returns begins to operate. So to the right of T double prime, the total variable cost curve is concave up, and your T total variable cost curve is increasing at an increasing rate. Please highlight a bullet point number 2 if you have your notes in front of you. At every point of output, your total cost is going to be equal to your total fixed cost plus your total variable costs. Your total cost curve has the same shape as your total variable cost, but is $60 above it. Thank you. This is the end of the first video on short run total cost curves.